When billionaire investor Stephen Cohen makes a move, Wall Street listens. He's known for his gutsy calls and market-beating returns. So, when 𝗗𝗟𝗧, Cohen's $23.5 billion asset management firm, dumps 87% of its Nvidia holdings, it's not just a blip on the radar, it's an earthquake. What did Cohen see that made him back away from Nvidia, a stock that's been a Wall Street darling for years? And more importantly, where is he putting his considerable capital now? Cohen's not one to follow the herd. He's a contrarian, a maverick, a lone wolf prowling the market for opportunities that others miss. So buckle up, because we're about to dive deep into the world of high finance, following the money trail to uncover Cohen's latest move into Chipotle Mexican Grill, especially after its monumental 50-for-1 stock split on June 25th. The Nvidia, the graphics chip giant, has been on a tear for years. Its chips power everything from gaming PCs to data centers, riding the waves of cryptocurrency mining and the artificial intelligence boom. Investors, including Cohen, piled into Nvidia, driving its stock price to stratospheric heights. But what goes up must come down. Recently, cracks began to appear in Nvidia's armor. The cryptocurrency bubble burst, demand for gaming PCs cooled, and competition in the data center market heated up. While Nvidia remained a powerhouse, its growth trajectory became less certain. Perhaps Cohen believed that Nvidia's high-flying days were coming to an end, at least in the short term. Cohen's decision to sell the majority of 𝗗𝗟𝗧's Nvidia stake speaks volumes. Stock splits, once a rare occurrence, have become increasingly common in recent years. Companies like Tesla, Apple, and Amazon have all split their stocks, making them more accessible to retail investors and potentially boosting their value. On the surface, a stock split doesn't change much. The company's market capitalization remains the same. It's just divided into more shares. However, a lower stock price can make the stock appear more affordable to individual investors, potentially leading to increased demand and a price bump. Cohen, with his deep understanding of market psychology, knows that stock splits can generate buzz and attract attention. But Cohen isn't just chasing hype. He's looking for companies with solid fundamentals, strong leadership, and a clear path to profitability. To understand Cohen's moves, you have to understand where he comes from. Cohen started trading as a teenager, using his own college fund to play the market. He built his fortune from the ground up, brick by brick, trade by trade. He founded SAC Capital in 1992 with $25 million. SAC became a hedge fund behemoth, generating eye-popping returns. Insider trading allegations led to a $1.8 billion settlement. In 2014, 𝗗𝗟𝗧 Asset Management was born from SAC. A new name, a new structure, but the same relentless pursuit of profits. Cohen is not your average investor. He's a market intuitive, a field player, a guy who seems to have an almost preternatural ability to sense where the market is going before it gets there. He's known for his speed, his decisiveness, his ability to process information and make bets in the blink of an eye. He's also known for his incredible risk tolerance. Cohen's not afraid to lose, as long as he's playing to win big. He embraces volatility, thrives on uncertainty, and isn't afraid to go against the grain. 𝗗𝗟𝗧 utilizes a variety of strategies, from fundamental analysis to quantitative modeling, but at its core it's all about identifying mispriced assets and exploiting those inefficiencies for profit. Cohen is constantly moving, buying, selling, hedging, adjusting his portfolio in response to the ever-changing market landscape. And it's this constant adaptation, this willingness to pivot and change course, that has allowed him to stay ahead of the curve for so long. If there's one word that defines Cohen's investment philosophy, it's contrarian. He's not interested in following the crowd, chasing the latest hot stock tip, or jumping on the bandwagon. In fact, he often does the opposite. Cohen made his fortune by zigging when everyone else was zagging. He bought during market panics, sold at the height of bubbles, and never shied away from making bold bets that others considered too risky. This contrarian approach is not for the faint of heart. It requires deep conviction, a high tolerance for risk, and the willingness to stand alone when everyone else is telling you you're wrong. The biggest profits, he believes, are made by going against the grain, by seeing what others miss, and by having the courage to act on those convictions. So, if Cohen is selling Nvidia, where is that money going? And what does a stock split have to do with it? Rumors are swirling on Wall Street, whispers of a company on the verge of breakout growth, a company whose stock has been split, making it more accessible to a wider range of investors. This isn't just any stock split. This is a stock split with a story, a narrative that has captured Cohen's attention and convinced him to bet big. We're talking about a company with disruptive technology, a strong leadership team, and a massive potential market. But what is this mysterious company? To find out, we'll have to dig deeper, follow the money trail, and uncover the secrets that lie at the heart of this supercharged stock split. Cohen's decision to sell Nvidia wasn't driven by panic or fear. This wasn't a knee-jerk reaction to a bad earnings report or a sudden market downturn. This was a calculated move, a strategic repositioning based on a deep understanding of both Nvidia's strengths and its limitations. While Nvidia had enjoyed a remarkable run, Cohen likely recognized that the company was facing headwinds. Competition in the semiconductor industry was heating up, with rivals like AMD and Intel nipping at Nvidia's heels. The cryptocurrency boom, which had fueled demand for Nvidia's high-end GPUs, was fading. Moreover, geopolitical tensions, particularly those involving China, cast a shadow over Nvidia's future prospects. Cohen, ever the pragmatist, likely recognized that Nvidia's valuation had become stretched. The tech landscape is in a state of perpetual evolution. What's hot today could be obsolete tomorrow. Cohen understands this better than most. He's constantly scanning the horizon, looking for the next big thing, the emerging trends that will shape the future. While semiconductors remain critical components of countless devices and systems, Cohen likely recognized that the next wave of innovation was going to be driven by software, data, and artificial intelligence. These are the areas where true value is created, where the real money is made. Nvidia, while a leader in GPUs, was primarily a hardware company. Cohen, always one step ahead, likely saw an opportunity to invest in companies that were better positioned to capitalize on the software and data revolution. So, if not Nvidia, then where was Cohen directing 𝗗𝗦𝗖𝗢𝗗𝗘's considerable capital? The answer, as it often does on Wall Street, lies in the whispers, the rumors, the cryptic filings that hint at a bigger story unfolding. Word on the street was that Cohen had set his sights on a company operating in a sector ripe for disruption, a sector with enormous growth potential and a compelling narrative that resonated with his contrarian instincts. This wasn't about chasing the latest meme stock or jumping on a crowded bandwagon. The specific company remained a closely guarded secret, but the rumors hinted at a player in the renewable energy sector. The stock split added another layer of intrigue to the story. While a stock split in itself doesn't change the underlying value of a company, it can act as a catalyst, making the stock more accessible to a broader range of investors. This increased demand can drive up the stock price, creating a virtuous cycle of growth and attracting even more investors. Cohen, with his deep understanding of market psychology, knew that a stock split could amplify the impact of his investment. The combination of a compelling company, a disruptive industry, and a well-timed stock split created the perfect storm. Whispers turned to roars as 𝗗𝗦𝗖𝗢𝗗𝗘's 13F filings revealed Cohen's hand. The mystery stock? None other than Chipotle Mexican Grill, a fast-casual restaurant chain. Not your typical tech darling, right? But that's classic Cohen seeing value where others see only sand and sunshine. Chipotle completed its first-ever stock split after the market closed on June 25th, with a significant 50-for-1 split, one of the largest in New York Stock Exchange history. During the second quarter, Cohen's investment fund purchased 1,458,700 shares of Chipotle, increasing its position by 446% to 1,785,950 shares, a notable rise from its March-end holdings. These numbers have been adjusted to reflect Chipotle's stock split. The appeal for 𝗗𝗦𝗖𝗢𝗗𝗃's investment team likely lies in Chipotle's well-established competitive advantages. One of Chipotle's major strengths is its differentiation in the competitive restaurant industry. The company's commitment to using responsibly raised meats without unnecessary antibiotics and sourcing local produce when available has struck a chord with consumers. Much like how grocery stores capitalized on the organic and natural food trend 2 decades ago, Chipotle's management recognized that customers were willing to pay more for better quality ingredients. This pricing power has proven especially valuable as food costs have risen in recent years. Chipotle's limited menu also sets it apart. By keeping offerings simple, the company ensures efficient meal preparation, keeping lines moving quickly. This approach also generates excitement whenever new items are added to the menu. Another boost to Chipotle's business has come from the introduction of Chipotlanes, drive-through lanes dedicated to mobile orders. This innovation has expanded the company's sales channels and helped introduce the brand to Generation Z. While Chipotle has consistently outperformed expectations since going public in January 2006, its valuation may be a concern for investors like Stephen Cohen. The company's forward price-to-earnings (PE) ratio of 45 as of October 11th is high for a restaurant chain. With some of its growth driven by price increases rather than higher order volumes, the elevated PE ratio seems even more stretched. After all, there's a limit to how much innovation can be expected from a restaurant business. Though Stephen Cohen has invested in a high-performing stock following its split, the stock's near-term upside might be limited. Hey, if you found this video insightful, give it a thumbs up and subscribe to the channel for more market-moving analysis. Let me know in the comments what you think about Cohen's move and what stocks you're watching. Until next time, happy investing.